Kia ora, and welcome to my Dawn Chorus for Sunday, August the 3rd. I'm Bernard Hickey for the Kaka. This is my daily podcast and video that goes out with my email newsletter on Substack. It's called the Kaka, and it's all about Aotearoa's political economy around housing, climate, and poverty. Now, today I wanted to talk about the announcement yesterday by the Prime Minister, Christopher Luxon, at the National Party conference in Christchurch of a new $20 to $40 fee for foreign tourists who are using the big four Great Walks. And it seems sensible. And it's one of those things we've seen a lot of in the last couple of years. This is where the government looks to put in a user pays approach, a new charge or an increased charge, to essentially avoid having to put its own capital, to invest its own money into either repairing an infrastructure deficit or building a new piece of capital. Now, you may think, why does this matter? And doesn't it make sense that user pays applies, particularly if it's a foreign tourist who seems to get a freebie on those big walks? Well, it's a pattern we've seen where the government doesn't fund a capital expenditure, either of its own or its share of one with councils. And that capital freeze, which is what the government did at the beginning of 2024, has led to increases in fees and charges. And in today's chart of the day, with the email newsletter, you can see how this has taken effect. So I just wanted to show you this to give you a sense of how this is working at the moment. So Christopher Luxon makes the announcement, and here's the chart that shows you what's happened to government set prices over the last year and a half. And you can see that it really started to take off in 2023 because Labor was doing some similar things, all in the aim of getting the budget back into surplus. And it's significantly risen again in the last year or so. And it's well above the levels it has been for most of the last decade, and certainly during COVID, when the government didn't want to add on extra fees and charges to people who were dealing with COVID. They were probably quite busy as well. So that has been a major factor in the inflation in the last couple of years. Government set prices. So this is fees and charges, council rates, but also in particular, electricity. And it's been one of the major drivers in prices in the last couple of months. And that is because our lines companies in particular set their prices in a regulated way. So the Commerce Commission looks at how much it costs the lines companies and Transpower to build new equipment and lines, and then works out what the cost of capital for that might be, and then regulates a price increase. Now, often that's done to avoid the council, which may own the lines company or the trust or the company or Transpower, from having to pay off its own balance sheet the capital cost and service the debt. Now, the reason this is important is that fees and charges and consumer prices are included in the consumer price index, as you can see there from the chart in the orange line. And that is something the Reserve Bank has to focus on. It has to keep inflation between 1% and 3% over the medium term. Now, one of the things that was done when the inflation targeting regime was set up in the late 80s, early 90s, was to ensure that the Reserve Bank didn't take into account the rise in the price of assets and capital when it set monetary policy. The fear there was, of course, if you'd seen some sort of boom in the stock market or the housing market, the Reserve Bank wasn't putting up interest rates simply because of a boom in asset values. The idea was to contain inflation in goods and services. So that meant capital costs are not included in the consumer price index, and even house prices, so the cost of owning a house, is not included in the consumer price index. And unlike in some other countries where they try to come up with a proxy for that cost, that capital cost for a homeowner, that's not done in New Zealand. So what you see, and also mortgage interest costs are not included in the consumer price index. So what you see is when the Reserve Bank puts up interest rates to slow down the economy, one of the fears it had was that if it puts up interest rates to slow down the economy, that is reflected through into a higher consumer price inflation rate, which the Reserve Bank has to act again by putting up interest rates even more. So it's worried about a doom loop, if you like. Now, one of the issues here is that if you see a structural change in the way that government manages its balance sheet, not borrowing off its own basis and paying interest costs off that debt, and instead loads those costs into consumer prices, what you're actually seeing is the Reserve Bank reacting not necessarily to a rise in inflation in consumer goods and services prices, but a rise in the use of fees and charges as a way to avoid the government and councils borrowing money. And that's the irony here. The government has been for the last year and a half saying it's all about taking pressure off inflation in order to get interest rates down, which it aims to use to get the economy going. However, in its desperation to stop spending government money, particularly on capital, so it's frozen investment in transport, local roads, housing, in many cases hospitals, and actually when you look at infrastructure spending, it is falling over the next 2 to 3 years. That is putting prices up. And so what you're seeing actually is the Reserve Bank recently just held interest rates because it was worried about this type of inflation. And the government's attempts to stop spending perversely and in an unintended way have actually increased inflation and made it more difficult for the Reserve Bank to cut interest rates. Now, that's one of the reasons why the economy is in a bit of a slump at the moment. And I think it's worth pointing out the sorts of issues that we're having. I'm Bernard Hickey. That was the Dawn Chorus for Sunday, August the 3rd. Ka kite anō.